Welcome back, everyone. Today on the Joseph Carlson Show, AMD is the big news of the day. The stock is up 29%, and this is after AMD announced a multi-year AI supply chip partnership with OpenAI. OpenAI is now becoming a kingmaker of sorts. They've already caused Oracle stock to surge dramatically in a single quarter, and now they're doing the same thing with AMD. Now, we're going to be taking a look at the details of this, as well as an interview with a representative from OpenAI and the CEO of AMD. They're going to be talking about this deal and explaining it to investors. So we'll be breaking down all this news, what it means for AMD in the long run, how it's going to impact NVIDIA, how it places AMD as a potential alternative, and what this means for Google, which is sitting back watching OpenAI spend a fortune to compete with Gemini. As well as there's other companies like ASML that are in the green on this news as well. We'll be looking at all of it in this episode. Now, in addition to that, we do have an interview with Paul Tudor Jones. He is a legendary investor, and he has more of a bearish outlook on things. I'll be responding to some of the points he brings up and how he considers today to basically be 1999. Not a good outlook from Paul Tudor Jones. And then finally, I'm managing two portfolios. One of them that's over $900,000 in value, a secondary portfolio that's near $400,000 in value. And what I did was take the time to break these down into their components, segmenting which type of companies I own and which ones I don't own in every single category, like the hyperscalers, the AI hardware companies, the data-centric compounders, and so on and so forth. We're going to be taking a look at the breakdown and composition of my portfolio, and I'll be giving some context into the thought process between the companies that I own and the ones that I don't own. So this is a jam-packed episode, a lot to get into. Let's go ahead and kick things off. Now we start things off jumping into AMD. It's not every day that you see a company of this size go up 30%. But it's becoming more common. We have seen this happen over the past couple of months, especially with Oracle. If you recall, Oracle announced that their customer commitments for their cloud had skyrocketed. In fact, we can look at the chart here. And I just want to retrace this because it seems like we're seeing some similar things over the past couple of months. This is the Oracle backlog. Now, it went in a single quarter from $138 billion, which was already growing rather fast. So this wasn't growing slowly, but it was growing at a normal organic pace, and then it grew completely abnormally with a $455 billion backlog. Now, they said that this backlog increased from around 3 different companies. We know that Meta was one of them, we know xAI was one of them, but the biggest one by far was OpenAI. Oracle stock price, as a result, also jumped significantly in a single day. From $225 to $328, a $100 jump in stock price in a day. So we've seen this before with a company just a couple months ago, and here we are seeing a very similar thing with AMD, but for a different reason. Now, the driving company behind this, 100%, this time is just OpenAI. So they're doing it again. It seems like whatever company has a partnership or goes into business with OpenAI immediately has its stock price up 30%. OpenAI is now the company calling the shots, the one that whatever they do business with, they are having a dramatic impact with that company because OpenAI needs so much compute. Now, in this case, they selected AMD, which is a bit of a surprise because we know that OpenAI has already these long-standing partnerships with NVIDIA. We've seen them at different podiums talking about their agreements and partnerships, how good of friends they are. And here we have them doing the same thing with AMD. Now, in terms of why they're doing this deal, we have an interview here with the co-founder of OpenAI and the CEO of AMD. They both have completely different incentives here, but it makes sense of why these two companies are partnering.
We need as much computing power as we can possibly get. And I think the whole industry right now is trying to really adapt to the amount of demand for AI services that we see coming over the next couple of years. And I think that when it comes to the suppliers of this computing power, I think that NVIDIA has something very special. We use them for training, we use them for inference. AMD, I think, also is really sort of delivering in terms of the next generation of chip that they've been working on. We've been providing feedback. We've been doing a lot of software work to be able to enable it for inference within our infrastructure. And we really see the whole ecosystem as being something that's coming together to deliver the amount of inference that will be required to bring AI to everyone at scale.
Now, he mentions a lot of things that are quite obvious. He mentions that they need as much compute as they can get. He mentions that NVIDIA is a great partner. He mentions that AMD also has something great going on, and we've been working with them as well. But it's what he leaves out that I find most interesting. He never says NVIDIA can't supply the compute that we need. He never said that. He never said NVIDIA just doesn't have enough. NVIDIA, in fact, probably could supply all the compute that OpenAI needs. They could fulfill every order that OpenAI needs. So there's some other incentive that OpenAI has other than a 100% partnership with NVIDIA. They want to diversify. They don't want everything to be too reliant on NVIDIA any more than Amazon's AWS or Google's Google Gemini or anyone else. Everybody's afraid of having too little of diversification, of having all of your products supplied by one single company. Because if you do that, you're giving that one single company way too much power. If NVIDIA controls all the compute processing for all these different companies, they hold all the chips. So OpenAI, even though they're not saying this directly, one of the major incentives of this move is to simply diversify away from NVIDIA, because NVIDIA, frankly, is just way too powerful in this race. They are the king of compute. They're the ones that really control the world. And we're seeing all these different companies try to diversify away from them. Google's doing it with their TPUs. Amazon's doing it with their Trainium. Microsoft is developing their own. Apple's developing their own. They're all trying to diversify away. Now, if we look at AMD, obviously they have pretty straightforward incentives for this deal. They want to make revenue and money. So having an additional big customer is always a good thing. But there's also other incentives as well.
Yeah, maybe, Jim, let me make a comment on that. First of all, I think we have to get, really on this big picture of, Sam and Greg need more AI compute, and, our job is to deliver that. The thought process around the warrants is, it's actually hard to build these, huge gigawatt deployments in data centers. And we wanted to make sure that this is a long-term deal. So it is really an opportunity for us to align AMD and OpenAI together over the long term. And the idea is, as OpenAI deploys compute, that's a huge benefit to AMD in terms of the amount of revenue that we get from that. Every gigawatt of compute is significant double-digit billions of revenue to us. And as part of that, we have to work really closely together to make sure those deployments are super successful. And as we do that, OpenAI gets to benefit, from some of the success of our work together. So it really is, the best in terms of tying performance to each other. And I want OpenAI to be extraordinarily successful, and this gives OpenAI a reason to want us to be successful as well.
AMD and OpenAI have closely tied their incentives together, where they're literally almost co-ownership in the success of this. So they both have the same overriding motivations to make this deal successful. But AMD has another very big overarching incentive here, another motivating factor, which is AMD for the longest time period has wanted to be considered a viable alternative to NVIDIA. They've been saying for a long period of time, look, we can supply some compute, we can supply inference, we can do this type of thing. And everybody's choosing NVIDIA. AMD has been left out over and over again throughout this entire process. NVIDIA is getting all the market share, all the growth, while AMD is sitting on the side the entire time saying, we're here too, we can supply compute, we can do it at a cheaper price than NVIDIA. AMD's overall ecosystem is not quite as powerful as NVIDIA's, but that misses the point. If they can offer great inference and great support at a reasonable price and diversify these different companies away from NVIDIA, many of these companies are going to jump onto it. So AMD in this deal is accomplishing two things. Not only is Lisa Su making it so that her company has tens of billions of dollars more revenue, not only is she partnering with one of the top companies in the world, which is OpenAI, but she's also establishing AMD as finally a viable alternative to NVIDIA. So this is a phenomenal deal for AMD. Just incredible. It's like hitting 3 home runs at the same time. It just could not be any better. I think the stock deserves to be up 20+%. I don't think that this is a crazy reaction. Some people may say this is an overreaction. I don't think so. It accomplishes so many good things for the company. And in terms of how other companies are impacted by this, there's no other way to read this than it is an incremental negative for NVIDIA. It's not going to destroy the company. It's not some kind of kill shot. It's not anything dramatic for NVIDIA, but this is an incremental negative. And the reason why is because NVIDIA is now being looked at as a company that can be diversified away from. There are other alternative viable options. And companies have been looking to do this for some time. So I think investors are not overreacting with this news on NVIDIA. They know that in most cases, NVIDIA is still the preferred partner, but now there are going to be other places to go. And if AMD keeps the momentum rolling, they could prove themselves to be a big pain for NVIDIA. Now, we also look at some other companies in this whole ecosystem. We have Google here. I also believe that this is incrementally bullish for Google, a company that's competing with OpenAI, but doing so without having to have these massive deal partnerships with all these different companies. Google is full stack. They have the infrastructure themselves. They're well along in developing their own chips, where they don't have to play these different types of games and different type of partnerships with other companies. Now, Google could do that if they choose, but consider the amount of money that OpenAI is spending and the type of partnerships they're making. Google already has a model as powerful or better than OpenAI's ChatGPT, and this model is already integrated into their entire stack. So I become incrementally more bullish, and I believe that Google does deserve to be up today on this news. It just shows how difficult it is to replicate what they've built. We also have another company that I think is a little bit more upstream, but this is another positive thing for ASML. So I'm not surprised to see the stock in the green today. Now, ASML is a bit more disconnected. It's a bit further back, further upstream from all these different down-level developments that we're seeing with companies like NVIDIA and AMD and Google. But every time there's more spend on CapEx for AI infrastructure, ASML benefits. And it benefits long term. So ASML is now $1,050 per share, up another 1.7%, and I believe it's deserved. The compounding continues for ASML. Now, as this bull market continues and there's more and more spend on AI, there's some people that are a bit more skeptical of what's going on right now. One of them is Paul Tudor Jones, a legendary trader and one of the most notable investors that bet against the big banks in the 2007 financial crisis. He got a lot of things right when calling bubbles before, and he believes that we're basically in a bubble today. He's asked directly which part of the bubble he thinks we're in, if we're still going to go higher or if things are just simply going to collapse.
It's like the Prince song. It's 1999. Party like it's 1999, right? Feels exactly like 1999. I don't know whether we'll actually replay it exactly, but I think all the ingredients are in place. And certainly from a trading standpoint, you have to position yourself like it's October 99. I don't see why you would do anything but that. And remember, the NASDAQ doubled between the first week of October 99 and March of 2000. So if it looks like a duck and quacks like a duck, it's probably not a chicken, right?
He's not really beating around the bush here. He is simply saying that it looks exactly like the pre-dot-com bubble. Now, again, he doesn't know for sure, and he'll admit he doesn't know for sure, but all the signs are there in his mind. In fact, he just says he can't understand why anybody would do anything other than prepare for it to be a bubble. Why would you act in any other way? He can't even conceive of it. He's so convinced that all the same type of attitudes, behaviors, stock prices, everything looks like 1999.
I think all the ingredients are in place for some kind of a blow-off. Will it happen? Again, history rhymes a lot, so I would think some version of it is going to happen again. Right. If anything now is so much more potentially explosive than 1999. 1999, we were looking at a rate hike in November. Now we're looking at a rate cut. We were looking at 4 more rate hikes before we actually topped in 2000. Now we're looking at 3 or 4 rate cuts, probably at least. So you have monetary policy that's going to take us to real rates of 0 or less, probably, depending upon the next Fed chair. And then the big difference is, obviously, fiscal policy. We had a budget surplus in 99, 2000. Now we've got a 6% budget deficit. So that combination, that fiscal monetary combination, is a brew that we haven't seen since, I guess, the post-war period, early 50s, something like that. And that was crazy times, right, coming out of the war.
Right now, all the factors are in place for a typical bubble. And he doesn't know how it's going to end, but he says it will end badly. It always does. He also mentions, though, that the biggest gains come right before the bubble. So you have your normal compounding year over year from the stock market, but then you have a year where it doubles more than it did the previous years. It's way above the average pace. You have this big surge upwards before you get the bubble. And that's very true. In fact, everything he says here is completely accurate. That's what we saw in 1999. That's also what we saw leading up to 2007. The stock market went crazy before the epic fall. And it's what we saw in 2021. In each case, the biggest gains came right before the following bear market and right as the bubble was about to deflate. So it's kind of this catch-22. You don't want to sit out of the market. That's not a great thing to do because then you're watching other people make gains. You're missing out on possibly the best time to invest. But also, if you stay fully invested, full beta, if you're in the most trendy stocks of the day, the ones that are surging up the most, those are inevitably going to be the ones that sell off the most in the following bear market. So in some cases, this is a big catch-22 for investors. And there are specific ways to mitigate the risk of participating in the downside of the bubble. There's different ways to address this problem of feeling that the market's becoming overvalued, but still wanting to invest in the best companies and not potentially forfeiting a lot of the best gains in the market. And that's the balance that I'm trying to accomplish with my portfolio. I have two portfolios. The first one is a passive income portfolio. This one's at $360,000 some odd dollars in gains. Then I have the story fund, the smaller of the two, with $160,000 in gains. They equate to around 500K in gains. So we have $500,000 in gains, which is great, but I don't want to lose all these gains in a bear market. I don't want to have all my gains evaporate overnight. In most cases, investors become overly bullish when things are going well. They overextend themselves and then they destroy their returns in the following ensuing bear market. And that's exactly what Warren Buffett has avoided throughout his career. Buffett knows that losing money and trying to make up for the lost money is much more difficult than just not losing money to begin with. And that is why, out of all the different goals that you can have with a portfolio, for example, you can say, I want to compound my portfolio with 20% gains per year or 15% per year. I want a portfolio of fast-growing companies or XYZ. You can have all these different ambitions with your portfolio. But above all of that, my personal goal with my $1.3 million portfolio, first and foremost, that I prioritize above everything else, is to not lose money. That is number one. I don't lose money. And I try not to lose money on any individual stock. Now, in some cases, it is just inevitable and unavoidable that some stock picks won't work out. But even in those cases, I don't want disastrous losses. I don't want top positions worth hundreds of thousands of dollars to crater in value, going down 70, 80%. That's what I avoid with my portfolio. And so far, I've been very successful at that. Before even considering growing my gains, growing the portfolio, I consider how I maintain what I already have. So that's priority number one. And that does separate me, I believe, a little bit from other content creators, influential people online, different financial accounts, because many of them have the biggest goal be swinging for the fences, trying to find the 10x stock, trying to find the one that will be the most flashy, that will have the biggest percentage gains. That's not my goal. So if you are one of the investors that wants to take a lot of risk, you don't mind losing a lot of money in the pursuit of having massive gains, there are better people to follow. My strategy is based off of minimizing risk, minimizing downside, while growing the top side at a faster pace than the S&P 500. And there's different ways that I try to accomplish that. Now, when I look at all these different holdings, what I did was I broke them down and put them in this list. I categorized them into different buckets, and I can go through the companies that I own compared to the ones that I don't own in these same buckets. First of all, we have an attempt here to participate in the AI trend, but do so in a very conservative, risk-adverse way. And I've done this to a huge degree. That is putting a lot of money in the so-called hyperscalers. Now, hyperscalers are the companies that have this massive cloud, that fulfill a lot of compute for the world and a lot of computational demand, IT infrastructure for the world with their massive cloud. And I put an enormous amount of capital into these companies. For example, just with Amazon alone, my position is $132,000. A massive position. $39,000 of that is gains. With Microsoft, an $85,000 position, half of that being gains, $43,000 in gains. With Google, I have two positions, one in each portfolio. The biggest one is the $89,000 I have in the passive income portfolio, or rather it's around $90,000 now, $24,000 in gains. And then in the story fund, this position there has performed incredibly, a $53,000 position with $30,000 in the green. So in Google today, I have $138,000, $139,000 with around $53,000 being gains. Just a massive position. And that reflects the high conviction I have in Google as being a company that has relatively very low downside and ample upside. To me, it represents one of the best risk-adjusted returns companies in the market. And even after the surge in stock price, because of a lot of good fundamental developments and improvements, like not having to sell off Chrome, like search data continuing to go upwards, all of that stuff is going in the right direction. I still believe that Google today represents one of the best risk-adjusted companies in the market. And I'll repeat that until it stops being the case. But right now, I think Google could easily go up to $300 per share. This huge amount of money invested still has ample upside in my portfolio. With Microsoft, this is a company that even though I'm massively in the green, I see a little less upside today. In my opinion, it's more of just a long-term hyperscaler software compounder. I see a lot of long-term gains, but not as immediate of gains as Google. Amazon is another one that right now I think has ample upside. I'd put it in close alignment with Google. I think the risk reward of the two is a little different. I think that Amazon's actually a little bit more volatile in which direction the stock will trade. So right now I view Google as a bit more dependable in going up over the next couple of years. Amazon may fluctuate more because the company is so much more dependent on the decisions management makes of what their CapEx investments will be. If they do minimal CapEx, if they start to taper off and they do more moderation, they focus on efficiency and profitability, I believe the profits will explode, the stock price will go up. If they double down and triple down on CapEx and AI spend, this one could continue to face a little bit of resistance over the next year. So this one I believe is still a great bet, but in the near term, I believe between these three that Google still has the most clear line of sight between another 10 to 20% gains in the short term. Then we have the one that I don't own, Oracle, which is a genuine hyperscaler, cloud computing company, and there's a reason that I don't own Oracle. Now, Oracle has performed incredible, so obviously it would have been nice if I'd owned Oracle, but I think that Oracle's performance, and the reason that it's up so much this year and over the past year, is because it's been very difficult to anticipate that increased demand in Oracle. It is far less organic than these other hyperscalers. In terms of a defensive investor, one that's prioritizing not losing money over making massive gains, I feel much better about investing in these companies that have a diversified customer base. They're going to grow and compound organically for a long period of time. Their fortunes aren't tied to any specific company like OpenAI changing their mind. Keep in mind that Oracle's customer count only being 200,000, with about 80% of their revenue coming from OpenAI, that's promised revenue. It doesn't mean it will for sure happen. That's just committed revenue, and there's ways for OpenAI to get out of it. So it is more risky future revenue than what Google, Microsoft, and Amazon have, with millions and millions of customers growing over time, and many of them diversified. So this is part of the reason why I've chosen to own these three and not the fourth one here, which is Oracle. You may not agree with it, but my thought process is to have a more defensive, more organically compounding portfolio. Then we get down to the next category here. I call this the semi-cyclical AI hardware compounders, primarily hardware companies. When we get into this category, I only own one company, which is ASML. And this is my play, my exposure into this category. And there's a very thoughtful approach into making this my pick over NVIDIA or AMD. Now, there's other companies as well that you can go into in this category. So I'm not saying these are the only ones, but these are three of, I believe, the top considerations. With NVIDIA and AMD, you're getting the companies that are by far the most cyclical, the most sporadic, the most volatile in their demand. You're getting the companies that surge up 30% whenever there's a big order. And then if the competitor gets a big order, they go down. If they don't have any big orders for a while, it goes down. And you can see the cyclicality in their demand in the fundamentals of these companies long term. Now, I'm not trying to bash these companies. They're all fantastic. They're great companies. But you can see the cyclicality over time. Here's AMD's long-term history. This is the earnings per share. Just take a look at what goes on with this company over the past 20 years. This is the profits of the company. And every time it goes down, this is losing money. So it makes money, loses money, makes a lot of money, loses a lot of money. And you see this roller coaster ride over time, over and over again. Now, in the past 5 years, things are looking really good, even though it almost went again into losing money mode back in 2023. But I look at this and I compare it to the type of companies that I own. You compare it to Google or Amazon or Microsoft. Any of these companies have far more steady and predictable earnings growth. They look far more like compounders than an AMD or an NVIDIA. Now, NVIDIA has created a bit more of an ecosystem. I believe this one is merging into a long-term compounder a bit more than AMD is. AMD is a little bit earlier in that phase. So with NVIDIA, you see the explosive growth here. But this doesn't look like a predictable, steady, organic compounder to me. It looks like a company that's had explosive growth in a single year, and it remains to be seen how much they can establish this as a long-term trend and continue this growth over time. Again, we've seen the cyclicality in AMD. We've seen the cyclicality in NVIDIA just a few years ago, and here we are in the growth surge. So to me, this just feels a bit riskier. ASML is more cyclical than many companies that I own, but in terms of comparing it to other companies in this category, like NVIDIA and AMD, it is far more predictable. Again, there's time periods where the earnings per share go down for a bit, but if you look since around 2015, it's had rather steady growth. Not perfectly linear, but this is rather steady growth for about 10 years. A whole decade of the earnings per share going higher. And part of this is being driven by the company's revenue by segment. If we look at how they make revenue, we can look at ASML and we notice that they have this portion right here. They have the normal logic and memory. Those are the devices they sell. They make a lot of money when they sell them. But then we have the IBM, the install base management. This is very, very steady. You can see it barely goes down when it goes down, and overall it's increasing. ASML is becoming a more service-based, steady grower company over time. And the way that they're accomplishing that is rather genius. Basically what they do is they sell these machines that they've been selling for the past 20 years, but they're through various iterations. Almost every single machine ASML has ever sold throughout its entire life is still in use. So even ones that they sold a decade ago, companies are still using, and with every single machine that they've sold, they have service agreements. So only ASML can service those machines. Plus, they're the only ones that know how to service them. So basically, they have a growing install base. Every single machine they sell, it gets serviced for year after year after year. ASML makes a growing proportion of their revenue through continual service because, again, they're servicing machines that they sold 10 years ago. So this portion of the company, the install base management, that is just growing over time organically as they sell more and more units. And ASML is selling more and more units. In the past 12 months, they've sold 365 lithography systems. All of these are going to be in use in the next 10 years at least. And ASML will have people servicing each one of these machines. And every single time you get these big orders with NVIDIA and AMD, it pushes demand upstream eventually to ASML. So I view ASML as my play in this category, my exposure to this type of demand while having a more conservative and more defensible approach. I don't have to deal with the huge fluctuations in demand that NVIDIA and AMD give you. Instead, I can sit back and hold a company that's becoming a service-based management company. It increases the amount of units sold. Those units last for 10 or 20 years, and they get serviced over and over again. And while the growth in ASML has not been quite as explosive, it's still been pretty good. I started buying my position this year, so January of 2025 is when I entered into the position. I'm up 60% on it. ASML is up 50% this year. So although we see big gains, and it's really nice to see all the gains happening in NVIDIA and AMD, I like seeing that as well because it feeds up to ASML, which is at the top of the food chain in this funnel. So this is my play into the semi-cyclical and AI hardware compounders, and you notice a trend here. In each category, I'm going for the companies that are a bit more conservative, a bit more defensible, and I believe have a more risk-adjusted return going forward. These are also companies that I believe will be less prone to have destruction happen if there is a bubble bursting. These ones I think will do all right in that scenario. Now, the next category that we get into is a bit of a diversification in my portfolio into a segment that I called data-centric compounders. You have MasterCard there. It's a data company, a network company. We have S&P Global, which is going through a sell-off right now because of FactSet. I think the company is going to be just fine. I continue to hold this one. It's still a rather large position. I have around $30,000 of gains. It's a $120,000 position. So S&P Global is a company that I just have in the background. I think it's going to be fine long-term. It's a very easy company to hold. I rarely ever feel pressure or concerns about it. You have Moody's, which is another company that they're so specialized in risk analysis and all the different consulting that they do. And they have this really moody credit rating portion of the business. I think Moody's is just an easy one to buy into when there's opportunity, put it in the back burners, never look at it again. Just hold it for the next 20 years. Then we have Equifax. This company's battling it out right now with FICO, but that's only with around 10 to 20% of its overall revenue. The majority of revenue and growth from Equifax is going to come from all of its different data options it offers, the value-added services. It's another high-margin, moderately growing company that produces cash flow year in and year out. These are companies that I think even if there was a massive market crash, I would feel very comfortable holding these ones. Then we move on to another category. This one I believe is struggling the most right now, and it's a category that I have very limited exposure to, and I'm probably going to be reducing my exposure to it over time, which is pure software compounders, companies like Intuit and Salesforce. These are tough companies to be in. The AI trade is just killing these companies. Investors are convinced that companies like Adobe, Salesforce, Intuit are going to be disrupted by artificial intelligence. Even in this category, I've still made money. I'm up $22,000 in Intuit, down $8,000 in Salesforce. Salesforce is my biggest loser by far of any company that I bought in the past couple of years. In fact, right now, it's basically the only company that I have in the red. It's only one that I feel like is a story that just keeps evolving in a negative way. Despite the fundamentals improving, the overall sentiment for Salesforce is completely in the gutter. Things could not be worse sentiment-wise. Over time, what I plan on doing is holding these companies, evaluating them, and I might look for opportune times to put them into other companies that I think are just a bit more out of this pure software category, into the more data-centric companies, the AI hyperscalers, even companies like ASML. I think all of those are more risk-reduced options than the pure software compounders that are really the target of this AI trade. Now, moving on, we get to what I call user/consumer secular compounders. These are stocks that I really love. I really love the companies that tons of people are obsessed with. And in fact, I'd like to grow the list of holdings here. There's companies not mentioned here like Uber, Spotify, Shopify, DoorDash. There's lots of great options of different companies that people are obsessed with. But in this category, I've definitely nailed a few of them. One of them that I've nailed is Texas Roadhouse. Massive gains on this one. I invested no more than I believe $30,000, $35,000 in this stock. Now it's a $40,000 gain. It's paid dividends the whole time. People are obsessed with Texas Roadhouse. I think it's a fantastic company. We have Netflix here. Of course, that's been a big one. It's going through a boycott right now. We'll see how that plays out. I personally believe that boycotts are typically short-term. They impact churn in the short term. Over the long term, Netflix continues to produce so much content. It's going to be very difficult to avoid. We have Costco. This is one that is in a category of very premium valuation. So I continue to just hold it right now. It's not a sell for me, but it is in the higher valuation hold category. I'll continue to hold it and let the fundamentals catch up for a bit. We have Booking Holdings. This one is a bit on the software side, but it's also just on a consumer side of being, I believe, a very high margin, capital-light company that's carved out a nice moat with travel through Europe. So I believe this one has more gains to come. And then finally, we get to Duolingo. This is one that is a little bit more risky than the rest of the companies I hold because it's more dependent on continued fast growth. If the revenue slows down from 35% to 20%, then the stock price will go down. But if we look at the fundamentals, this is an incredibly strong company. It has organic growth. It's growing without acquisition. It has very high margins. It's already profitable. It has a huge total addressable market. It has a subscription-based revenue model. So very reliable, predictable revenue and profits from the company. And there's a lot of very attractive attributes. Again, the balance sheet is excellent. They have a lot of cash and no debt. They grow primarily through word of mouth. There's just a lot of things I like about this company. But I do note that this one's slightly riskier than most companies. That's why the holding size in my initial investment is smaller. I sized this one down smaller to account for the additional risk. So that's how I break down my holdings. Not every one of them is going to be the best holding, but I believe that this portfolio has enough exposure with enough upside while protecting myself against epic bubbles. So let me know what you think, how you compare this with your portfolio. But that's going to be it for this time. Hope you enjoyed. See you in the next one.